Tesla was only worth about $20 billion. So you can see with all this money, Apple couldn't even create a Tesla company, and all it did was buy back its shares, right? So what is the replacement value of something like Tesla, even though it's worth 50 to 80 billion dollars? We have Volkswagen, GE, I mean GM, Ford. They claim that they're going to make better EV cars, but if you look at their cars in the next 5 years, it's still not up to par with what Tesla is making in today's term. Another way you can look at intrinsic value is simply a DCF model. This is what everyone learns in business school. The only problem with this DCF model is you need to have intimate knowledge, again, of the company. It doesn't matter what numbers we use. We can all create numbers in our heads, right? But the numbers are only as accurate as our knowledge and not information. So what are the companies you should look for when you're buying these, when you're trying to hand select your stocks? You can pick a company like Walmart that has a cost advantage. You can pick a company like Apple, where all of my songs and music are stuck on Apple, my pictures. It's hard for me to move to Android. The network effect, all your friends are on LinkedIn, or all your girlfriends and boyfriends are on Tinder. The number of users. And it's the popular club to be in. No one wants to wait until no one wants to go into that club where there's only like 5 people in there. Everyone wants to go into that club where the line's like out the door around the building. And another thing you can invest in is look for things that has intangible assets, right? Hotels have license to operate in certain cities that's next to metro stations. Coca-Cola had a business license. I can't just make my own fizz Coca-Cola drink at home and print a use a Coca-Cola bottle and go sell it outside. I can't fraudulently make Nike shoes or Under Armour apparel. And then you can also look at other intangible assets, as in the locality of where the business is at. And then you can look at the management team or the culture. Now, if you're looking at management team and culture, these two traits are more important for companies that are new to the market or they're on hyper growth. For example, Facebook and Tesla are new companies. They require the jockey to perform. They're not the horse like Coca-Cola, where the horse can take in any CEO and Coca-Cola will still perform regularly the same, right? Now, in terms of what do these high quality companies represent, overall, they will represent higher net profit, higher ROIC, and they will grow a bigger market share over the long run. Tesla started out with 1 or 2 EV cars and grew a bigger market share. The advertisement world was ruled by Google until Facebook came along, right? Now, if you're looking for fundamental financial traits, you should look for companies today that are that have credit ratings at A or B levels, right? Like triple Bs. It's sort of like your credit score rating. Would you lend a friend that's always broke money? No, you would lend a friend that has triple A or triple A credit rating scores, right? And typically, if you're a high quality company, your return on investment capital is going to be above 12% year after year. If you're looking at companies like Boeing, for example, their credit rating has dropped, and the company has dropped as well. If you understand cash flow really, really well and interest rate payments plan, if you look into Boeing, you want to short it ahead of the downgrade, you would have made over 60, 70% return just shorting Boeing based off of their credit profile. Now, in life, when we're investing, we don't want to be like this truck. We have all this money and then we invest in something that doesn't have a margin of safety, and then we're stuck in the middle, right? We want to come up with a valuation, but use that valuation with a margin of safety so that if there's something that we haven't thought about that goes wrong, we can manage our risk. For example, if oil somehow spike up in the next 5 years and goes back to the 100 level, then airlines margins will go down quickly. Airlines expenses are usually 60% that are caused by oil prices. Now, if you see this line, this is your intrinsic value line, and every day the chart will go up and down, right? And you always want to buy it below what you found out to be is the intrinsic value. You know, your investment analysis should be based on margin of safety, so therefore you're protected against your own research. Now, here's a fun exercise. We can talk about determining the value of a brand, right? You can pay 100% more for Coca-Cola or a Safeway refresh. So when you're doing the intrinsic value of a company, these are kind of like things you want to think about in terms of what are people actually paying for this value. What price are they paying versus the competitor price? If you can see right now, Coca-Cola it's almost it's ahead of all of its competition in terms of pricing because it's something everyone wants to drink, even though no one can really tell the difference. So when you're investing, you have to think about your overall investment objectives. Is it to outperform the market or to get the market returns? If you're trying to outperform the market, you need to have an intimate understanding and the knowledge of investing in something so you can come up with intrinsic value, right? If you're investing passively and you're not trying to beat the market, then you want to automate your investment plans, dollar cost averaging. You want to understand that in 10 years or 20 years, you want to buy a house with it or retire with $1 million. Whatever your objectives are is how much money you should spend on investment. Now, these are some more informational things about value investment that you can look at. When it comes to value investment, now is the opportunity, right? We're in a bear market. Everyone's overreacting to news. And when things get great again, there would be volatility in the markets because, unemployment might grow for the next 3 months before it stabilizes. So there are always opportunities out there as long as you're not overreacting to things and buying things when it's cheaper. Don't buy it just because it's going up today or down today. Buy the investment when it's below its intrinsic value. To become a better investor over time, you want to develop more knowledge, right? Buffett stayed out of technology stocks for 60 years plus, and he still outperformed the market a majority of the time. So just because you like to invest in Tesla, but you know nothing about EV or batteries, you're not going to miss out. There are a lot of other opportunities for you to make money in it. And at the age of 86, Warren Buffett finally invested in tech stocks like Apple and Amazon, right? So as you grow over time, you can develop more investment skills. We already talked about these valuation methods, so I'll skip over it. Now, if you're picking your own stocks, what you should do right now is if you really want to actively invest, then stick with 20 stocks. There are a lot of studies out there. I mean, even if you follow 10 companies, it takes a lot of research just to follow 10 companies, especially if you follow 10 companies in 10 different industries. If you follow 10 companies in the same industry, like you buy Coca-Cola and Pepsi, Monster and whatever beverages, then yeah, that's a little bit easier for you to invest. But 20 stocks is kind of like the favorite number out there that a lot of economics and investors have looked at. um, it gives you a better diversified portfolio risk. You don't have to invest in multiple industries. You can invest in one or two industry. Again, it's if you understand what the company is going to do in the next 10 to 20 years, then you should have no problem with investing in one industry, right? For example, in the 1980s, you can either choose to invest in a lot of oil companies, or you can invest in all technology companies like Microsoft or Apple, right? Now, if you look into the future of 2020, where oil companies are at or where software companies are at, software obviously will outperform the oil industry by 2000x. So it's not about picking an industry that will win or not. It's about you in particular with your knowledge base on what you can do to invest. Now, for anyone that is new to investment and are reading their retirement plans, these are things that you can read in your retirement funds to help you understand your investment risk and how much expenses you are paying for it. So why you should invest in the stock market? If you can see overall, U.S. markets in the long run will outperform Canadian markets, gold, houses, inflation, etc. More statistics on, stock markets outperforming real estate, corporate bonds in different periods of time. Again, more analysis on stocks versus real estate. More information on the Dow Jones and real estate. It shows that real estate was doing better in a 12-year period. So there are times when you can make investment in real estate or other assets if the valuation is low enough. You just have to know when it's low enough. A lot of people are gambling or risking themselves in seeing the bottom of oil prices, right? That's not something I know, but a lot of people out there feels like oil is at the bottom and it's going to go up in the next 5 years. What if it stay low for 3 years and then they're going to pump more oil after that, or create better battery technologies where we don't need as much oil in the next 3 to 4 years? That's not something I know about, but I'm just giving you an example of things that could happen. If stocks are a better investment in the long run, then what's the catch? The catch is in the short run, the medium run, it looks like stocks would not do anything, but in the long run, stocks will perform, right? A lot of people don't have patience to wait 5 minutes for a burger, or 10 minutes or 30 minutes for a steak, or what about, if you're going to think about 30 years for something great to happen. Usually when we want something great to happen, we want it quicker and quickly instead of waiting for the long term. Remember that volatility in the stock market is not risk. Risk is the financial fundamental understanding of the business. So don't try to do a technical analysis unless you have like a PhD in predictive analytics where you can automate the trading desk for you. Investing for the first time for anyone that's out there, quickly, make sure you pay off all your interest rates that are above 6 to 5%. Second step is to start doing passive investment to get your feet wet. And third, once you have done those 2 steps, then pick a company that you know really well and learn how to read financial statements and the annual reports. Financial jargons, ETFs, and index funds. I'm going to just quickly skip through this. You can email me questions about it. Let's see. Does everyone see the long-term compounders? Or generating risk? Let's see. Can everyone see this?
Yep.
All right. All right. Generating ideas. All right. So if you want to pick individual stocks, what are some ideas out there that you can think about and learn about? I'll mention two important case studies about these two companies, Southwest and Progressive Insurance. So, why has Southwest been the only company in U.S. history to never declare airline bankruptcy? Well, first, they became a low budgeted airline by focusing on destinations that weren't popular, so that it was cheaper for them to negotiate pricing from one airport to the next. The second thing is they use one type of airplane versus their competitors that use like 5, 6 variation of airplanes, so that their pilots can easily get on the next plane without additional training. Um, and then they also enable their technology to keep costs down, right? And Progressive Insurance has insurance in itself is a very competitive business. There are thousands of insurance companies out there, and there's hundreds of them that would declare bankruptcy. The most popular thing about Progressive Insurance is that, let's say if you were trying to get a car insurance rate and Progressive Insurance says it's going to cost you $200 a month with us, but if you go to Geico, it will cost $150 with Geico. You're like, wow, this is so great. Progressive is sending me to their competitors that's offering me a cheaper price, right? What's the catch, right? The catch is Progressive has their own insurance data risk versus a majority of companies out there that buys external data and then manage that predictive data risk on your driving habits. So because Progressive has the knowledge versus other insurance companies that just have information that they bought, they will send you to their competitors that's offering you a cheaper price because you are actually a higher risk to Progressive. And then when you get into a car accident with Geico, then Geico will finally readjust their risks where Progressive already knew the risk that you had driving. So it makes Progressive look great at customer service, and then their competitors are confused why Progressive is even sending customers to them. But now that all insurance companies know this, they try to copy Progressive Insurance business model. But these are, intimate knowledge and ideas where you have to learn and read about these companies. And if you read it and learn it first, then you can buy it at a lower valuation, right? If you're the 100th person that read the article after someone published Progressive Insurance business model, you might get in at a low valuation, but you are going to do a lot better if you discover it yourself. All right. So I'm going to quickly jump through these slides because I want Fatty to present his valuation on a grocery company that I think that would do well in this economic condition. If you want to see the entire slide, just message me on the meetup group on my email. It's tomwin@agarwoodcapital.com. I just want to close it off with principles of investing, right? Invest, don't trade or speculate. No investment is the best. Always buy low. Buy bargain stocks among quality companies. most bargains are bargains for a reason. And there are safety in numbers, diversify. Always do your homework first. Don't take the word of the experts. Don't be like progressive insurance competitors, just seeking information because it will eventually bite you back. Um, if you're actively investing, make sure you're aggressively monitoring your investments, right? And don't panic. Uh, the best things to learn are from your own mistakes. I carry my own notebook that I write down. I also do it digitally. Um, think more clearly, meditate in your life. There's no free lunch. Don't invest because something's hot or something's bad. Um, and typically, if you're a new investor, stay away from IPO and run your numbers, do research, and don't be fearful or negative too often. For over 100 years, stock market has beaten every other asset class, especially in the U.S. markets, right? And if you want to learn, there are a lot of free resources out there that I'm pretty sure you're aware of. Um, Over time, the only thing I would mention with Seeking Alpha is there's a lot of people that writes a whole bunch of Seeking Alpha things. Go to the specialists that are specialized in real estate or software or a particular healthcare market. They will use particular jargons that are within their own industry. Don't go to a generalist who just speaks about random stocks, right? And we host our value investment groups weekly before this coronavirus thing in Washington, D.C. It's usually at the library of Capitol Hill, or we host it at Shaw Neighborhood. And I'm planning to do a once in a month live seminar like this to talk about value investment, value pitch, and we're going to present different research or a number of various books that we have read. To give you an example of books that we would talk about, it's like What Works on Wall Street, and a book on how to think like an algorithm. These are things that we share in our investment groups so that we can sharpen our own ideas and explore new ideas while also giving an opportunity to teach others that are new to the investment industry.